Welcome back. This is Market on Close. I'm your host this afternoon, J.D. Durkin. Let's now break down the commodities market with longtime friend of the show, Scott Bauer, CEO of Prosper Trading Academy. Scott, thank you for being here. So let's start with a look at the dollar. Give me your sense about the continued weakness. What are you following and how much lower realistically could it go?
I mean, it's already broken through a couple spots that I thought would really hold as support. And, you've got gold rallying. So is gold rallying because the dollar is falling or vice versa? But, in a bigger picture, speculation about Powell being replaced certainly hurts the dollar. As you mentioned, we're like basically at 3.5-year lows here. And so when we look at that, I mean, it's a pretty pivotal spot that it's trading at right now. In fact, it's headed as we close today for its worst first half performance since 1973. There's so much concern, consternation, if you will, out there about the trade and economic policies of the administration and the debt that we are going to continue to rack up.
At what point does the dollar weakness become a bigger problem, either through the lens of the Fed or Treasuries?
I think we're getting there right now. I mean, it's hard to put a specific number on it. You could say 96, 95, 90. That would be, in my opinion, really, all lights go off if we got down that low. But I think that the Fed, the Treasury right now, they've got to be discussing this and figuring out how they can put an end to this weakness right now.
Yeah, let me get your sense on what we're seeing for crude. Are we looking at supply chain related challenges, geopolitics? What's at play here to see crude now hovering right around the 65 level?
Well, yes, and yes. And then you throw into the mix that the U.S. production just hit a record, almost 13.5 million barrels per day, excuse me. So there's no lack of supply anywhere. There really isn't. And all through the crisis, the Middle East crisis that we've seen over the last few weeks, when I've talked about this, I said it's really a sell the rally event. So I don't want to buy on a dip necessarily, but I want to sell when we get these spikes because, yes, the geopolitical issue, that's not going away right now, but everything else out there from supply, the lack of demand, especially coming out of China, is really showing here that oil, if it weren't for what's going on in the Middle East right now, we'd probably be back in the mid 50s.
How do you interpret the movement we've seen in crude and oil overall relative to broader inflation trends, I wonder, especially during a time when we listen very closely to Fed officials and their gauge being data dependent on inflation? Crude's a big part of the equation.
It's a huge part of the equation. And I think, last week or when the conflict started a couple of weeks ago, there was some really serious discussion about how inflationary this would be if we really did see oil at 75, 85, even, there were calls for triple digits. So right now, it's probably not a big part of the discussion here, but it certainly has to be on everybody's radar, on everybody's minds that, if things unfortunately happen to pick up again in the Mideast and we start to see $80+ a barrel, that is not going to be a good thing for the Fed in terms of inflation, in terms of reducing rates. But again, I really think that this is a sell the rip, not a buy the dip scenario.
Yeah, let me get your take on the VIX here, slightly elevated, up about 32 basis points. But overall, I would argue it's been surprisingly subdued, despite this backdrop of macroeconomic uncertainty, geopolitical risk. What do you make of how we have seen the VIX move and its movement today in particular to kick off the short trading week?
I personally think it's too cheap. And I know that it's summer trade, right? And if we look historically over the summer, we'll probably see a VIX lower than where it is right now. But for everything that you just pointed out, and all of the geopolitical uncertainty, the Fed, the new budget bill, all of this, volatility is way too low in my estimation. So, seeing a VIX around 17 or 18 historically is not cheap. I think it's too cheap for now. And what we have to keep in mind is if we see a VIX of 16, that's approximately a 1% daily move in the S&Ps. We typically are seeing that. Now, we're not today. It's a very slow day, and this may be a slow week just because of the holiday. Overall, though, I think VIX is too cheap.
What would be a potential catalyst to trigger a volatility spike? Obviously, we've seen a handful of them already so far year to date, when we not really cheering on for many of them in the second half of 2025, but they could happen. And as we've seen already with this presidency, they can happen very quickly, Scott.
Absolutely. I mean, we know that we're at, we'll call it risk of a tweet coming out at any time of the day. But I think the two pressing things are, one, escalation again in the Middle East, and then two, inflationary data. You know, with this week, even though it's a shortened week, we get so much important eco data this week, ending up with the jobs report on Thursday, that if we start to see these inflation numbers really picking up, and then, you know, the CME FedWatch tool or the market is now pricing in maybe only one potential decline in rates this year, and that gets pushed out from September, that can really take a quick spike into the VIX.
Scott Bauer is the CEO of Prosper Trading Academy, getting us going here on a Monday. I appreciate your much needed context to help us make heads and tails of everything we're seeing. Scott, thanks a lot.